G'day expats, welcome to another episode of Expat Chat, episode 45 today. As always, joined with my co-host, friend, colleague, Brett Evans, the Managing Director for the Europe, Middle East region and the Africas. How you going, Brett? How's the sandpit treating you today?
Mate, it's physio day today, just to explain to folks out there, when you see me in a suit versus in a polo with the Atlas shirt on, if you see me in the polo, it means it's physio day. Still working on the shoulder. The struggle is real, and the road is long. But shout out to all the Aussie expat physios out there. You're doing a good job, guys. Thank you very much. Keeping me going anyway. And to the folks out there listening and watching, I'm joined by my colleague and mate, James Ridley, who is the Managing Director of the APAC region. G'day, mate.
G'day, mate. Now, I'm sure you've learnt your lesson staying away from horses. That was a long time ago, that injury now. It feels like a long time ago.
It's got to be 5 months in a couple of weeks' time. So, bit of a handbrake on life at the moment. But anyway, I'm getting flexibility with it, which is good. So had a cortisone injection. Do not recommend that to anyone. That was not a pleasant experience, and the first 2 weeks wasn't very comfortable, but getting better now. But mate, every day, every week getting better, and I said, the physio certainly helps a lot in getting that through.
Absolutely. No, that's great, man. I mean, as you said, road to recovery is always slow when you have those kind of injuries. Now that you've got titanium or whatever kind of metal in you.
I've got the plate and 8 bolts. So
that's right. Yeah, that's right, man. Yeah. Listen, I wanted to talk about today's topic. Everything that's going on right now, I'm sure everyone's been keeping an eye on the share markets. There's just so much going on for the start of the year, and it's already May. This year is just flying behind us. Very soon, obviously, we've all got to go to the election polls. You see a lot in all the Facebook groups, actually, people saying, oh, listen, do you want to come over? And you can sign off on my ballot, obviously, because they're doing it from afar, and I'll sign yours. So it's good to see expats helping each other out to obviously do those ballots and email them in and post them in. Posting them in, postal ballot. But today, with everything going on, I thought we'd talk about investing in volatile markets, because I think it's just such a key theme right now. A lot of queries coming in from inquiries and prospects just asking the question, volatile markets, how do you go about it? What's the strategies that you guys employ? So really good topic.
Right, before we go any further, let's do a quick compliance disclaimer. All information that you have the privilege and pleasure of listening today should be deemed as educational and informational purposes only.
Absolutely.
I'm just going to mix it up. Some weeks I'll do ones and other ones.
Mate, that was smooth. That was very smooth. I like that one. That was good.
I've got a good head for radio. I keep saying that. I should be, RTHK for those in Hong Kong. That's what that is. Hong Kong.
Yeah, I mean, share markets, they've been crazy lately, and I guess it's just most markets. They are probably the most powerful and I would say, pricing mechanism, because they absorb all the data points, inflation, unemployment rates. You look at now interest rates going up, earnings of different companies all around the world, GDP growth, everything. It's priced into markets right now, and I guess things have slowed down compared to 2021 calendar year. That's normal. But market will, I would say, still remain a little bit volatile. But I'd say right now everything's priced in. We're back at fair value, so I don't think there'll be any further big drops or anything like that. I think it's just volatility is probably going to be the main thing that we'll see probably for the next 6 months.
No, I think to explain to the folks out there too, where the equity markets and money markets are different from property markets, is you get a instantaneous pricing in terms of an event that's going on, whether it's a change in interest rates, whether it's an invasion of a country, whatever happens, it prices that event in instantaneously. That's where we get these market movements, whether up or down or sideways. Where it's different for properties is the property doesn't reprice until there's a transaction. So an event could occur, like right now, we've got rising interest rates in Australia and property prices are coming back, but you don't know that until you actually sell the property. There's not a ticker tape on the front balcony that says your price is worth this today. So that can obviously cause a bit of discomfort for some folks. Other folks, they don't really care, they don't watch it. To me, it's something that, as long as you're aware of what's going on and in the back of your mind have this general belief that that equity markets are generally an optimistic beast. It wants to go up over time, and it has gone up over time, and always has gone up over time, like property.
Yeah.
But where it gets into a bit of consternation is obviously you see a lot of change in a very short amount of time. And like we were discussing before we jumped on the call, pardon the French, a lot of shit's gone down in the last 6 months. When you look at an invasion of, a country by Russia, you've got China undergoing the largest lockdown in the world at the moment and extending. And then you've got crazy inflation numbers with rising interest rates. And this is only up to May. So what's happened is there's been this massive digestion of all this information. Let's just look at one issue. Let's look at China. China's slowing economy because everyone's locked down means there'll be less demand for Australian exports. So that in turn is going to affect the Australian side. Let's look at what UK is dealing with. Now they're talking about another Brexit. So they're now talking going into trade wars against Europe. That's going to affect UK economy. So there's all these data points, and the market's very good at doing it quickly because there's a lot of resources out there and a lot of clue people who can work out, okay, if China's GDP falls by 10% over the next 12 months, this is what the dollar cost will be. But we've just got a lot of things going on right now. But as you say, the market now is acting fully informed. And the interesting thing is, even with the falls that have been occurring over the last, couple of months, we're still above where the market fell when Jerome Powell, who's the boss over at US Fed, dropped the interest rate bombs on the 27th of Jan. So all it means is we've just given up what we've made since the 27th of Jan. We haven't actually lost anything in terms of that regard. But what it means is we're now, the market's priced in for the new norm over the next 12 months. Successive rate rises in Australia, successive rate rises in the US. If it doesn't happen, then the market's going to take umbrage to that and enjoy it. You'll go up even more. But if it does happen, it's not a surprise because the market's priced it in.
Exactly right. And I mean, you look at interest rates, and it's such a common topic right now. And I think on our previous episode, we talked about Clive Palmer.
Yep. Changing the constitution.
Isn't he? One of his new campaigns, I don't know whether he's still got the other one up, is make, what was it? It was make owner-occupier mortgage repayments tax deductible. I was like, I could probably get around that one. I reckon that's not a bad one. I think they're going to have a cap on it. And I was just like, that'd be interesting. But then I was just like, it's encouraging property ownership, which is also a good thing. But obviously it's Clive being Clive. One thing with interest rates that's going on right now, and when you look at sort of the 10-year Australian government bond income yields, or the yield on those, they're about 3%. So they're always a good indicator of potentially where the cash rate is. They're not correct. It's just a bit of a precursor and maybe looking through the lens into the future.
I will point out that more of an idea than the RBA, just saying that.
Yeah. That's a bit of a stab. I mean, hey, listen.
Justifiable stab. I mean, the money market was pricing in a rate rise in 2022. The RBA said 2024. Who was right?
I know. And listen, Governor Lowe, he's got a hard job, and he did come out, was it at the national press conference after they moved on rates, maybe a week or two ago? He said, listen, we got it wrong. We got 2024 wrong, and then we got 2023 wrong, and we were only going off the data that we could base our decision on, and unfortunately that data has changed a lot in 6 months. It's changed a huge amount. So now he's like, okay, we're going to start lifting. Very interesting to see that is the CEO of CBA. He came out and says, I don't think they'll go, 1.5%, 2.5% over the next sort of year or two. His belief, Matt Coman, I don't know if I pronounced that right. He reckons RBA will only go up by 1%. That's all they'll need to do. But I was just, in my mind, the cash rate, that's too low. I honestly believe the cash rate will have to go 2.5 to slow things down. But it's going to take a while to get.
Money market's pricing in 2.25 by February next year, and I think they're bang on the money. To me, if you look at consumer confidence is coming down, but that's not translating into dollars. People are still spending.
No.
So you need that contraction in spending in order to slow things down. And that's why you raise interest rates. The cost of money becomes more expensive, and off we go. So, to me, if I was a betting man, I'm going to call 25 basis points in June, 25 basis points in July, and possibly 25 basis points in August.
Oh, ladies and gentlemen, should we make a note of this? And then if
we'll come back in September and see if I was right.
if yeah, maybe Brett, if you're right, I'll send over a carton of Stonewood, some beer.
Done.
If you're wrong, I think you need to send me a local carton of something. I think we'll make a note in the show notes. Yeah, a bit of a bet. I like that.
I'll send you what's called a shawarma. So done.
Shawarma.
Yeah, for those in the list out there, know exactly what I'm talking about and know that I've got better in the deal.
Now I'm gonna have to Google that after. That's just you spending too much time over there. Now, I mean, the way markets are right now, investing through volatile markets. I mean, right now, no one has that crystal ball, and right now, most share markets have priced in interest rates going up by anywhere between, I'd say, 2 to 3% over the next 12 to 24 months. That's normal. That's good. They've priced it in, but it also means markets are still very volatile. What's interesting to note, and a really good data point that came out very recently, after COVID hit and you had all this record stimulus, you had this record amount of payments just being dished out in the US, in Australia, in a lot of different countries, free cash essentially for a lot of people. And all that money did get invested, record savings as well in the offset accounts and those sort of things. Of all the money that climbed into share markets just after COVID, only about 3% has actually moved out of the market since then. So that's actually good news because a lot of people are still, holding their nerve, long-term investors. It's probably, I would say, a lot of the novice investors that climbed into your robo-advisor accounts and all those sort of things.
Meme accounts and
meme investors, all those sort of things. Unfortunately, they're the ones that get spooked the easiest, and that's probably what we've seen a lot in the recent months, and there's a lot of it as well. So investing in volatile markets, I mean, what would be your 2 cents, when investing in I suppose, volatile markets? I mean, the common one that comes to mind is dollar cost averaging.
To me, it's dollar cost averaging and looking at the business. I mean, I think we are so data-driven these days. And let's come back to Governor Lowe's comments, and I'll even bring in a side issue of the Bureau of Meteorology. So Governor Lowe cooked the books. He absolutely screwed the pooch because he was focusing on the data and not lifting his head up and looking at the bigger picture of what's going on, anticipating what's going on.
Yeah.
Same thing happens with the Bureau of Meteorology. I mean, how many times did they not issue a storm warning until the storm's on the place? When you open the window and look out, you'd see the thing coming towards you. Hey, guess what? There might be a bit of rain coming. And to me, that's the same approach that investors need to take. When you're looking at the market and it says down 1%, it doesn't mean every company is down 1%. Some companies might be down 2%. Some companies might be down 0%. But on average, the market is down 1%. Go through and just don't invest for the sake of investing. Go through and look at companies that make sense in this market, in this environment. You look at a scenario of a business that is, you're looking to invest in. Look at like a mum and dad. A mum and dad, when they buy a property, they'll put down a 20% deposit, they'll borrow 80%. Their gearing is 80%. Treat the company the same way. What is the gearing ratio of the company? Is it highly geared? Well, you don't really want a highly geared company in a rising rate environment. Then also too, you're looking at a market that is still very, from an economic point of view, still very fractured. So are they a bricks and mortar business only, or do they have online capacity? Are they able to navigate? Are they, evolutionary in terms of their business model? Are they a market leader? They're the sort of companies, they will always make money. And, to me, and we've been doing this with the investment community over the last couple of months, is going through our portfolios and just looking out for the next 12 months. We've all got a pretty good idea of what the next 12 months looks like. Higher interest rates, potentially slowing economy, and also to, friction out of both China and the Ukraine. But it doesn't mean people aren't going to stop putting bull bars on their car, for example, with ARB. There's all that sort of machination. So to me, you've got the borders open now, people are coming out. So tourism, is a consideration for portfolios.
Oh, yeah, that's a really good point you talk about tourism, Brett. ABS, they released their data packs. It's remarkable to see all the departures and arrivals. So departures has gone up dramatically over probably the last 5 months, which is a really good indicator that there's a lot of expats heading overseas again, or a lot of new expats that have head overseas for work, and there's not too many that are returning either when you look at the comparison. So very interesting to see that, just in terms of sort of net migration numbers, where we're not really getting much in terms of growth right now. Everyone's leaving Australia, probably because of wage growth, to be honest.
It's an exodus. And that's what the feedback that I'm getting when I talk to folks who are leaving for the first time or leaving again. Mm-hmm. Australia is expensive, and from a wages growth, there is little to no wage growth. Whereas overseas, they're offered a larger salary, but coming back to what I was saying before about when you're looking at investments, it is like buying a car. What car do you want? Do you want a Porsche? Do you want a Tarago? Do you want a Nissan Sunny? Do you want, you go through, and that should be your portfolio. Then to take what you're saying before about dollar cost averaging, we don't know when the bottom is until after the market's gone through. But we know when everything is priced in, like it is now. But is today the day? Is it tomorrow? Is it next day? No one knows. Anyone who tells you they know is bullshitting. Mm-hmm. What it comes down to is going, well, the market right now is acting fully informed on this scenario going forward. There's a lot of emotion involved, so it may have overcooked on the sell-off.
Yeah,
I've got X amount to spend. I'm going to put in 20% now just to get a foot in the door, and then see how I go. Mm-hmm. And then watch it for the next week, month, whatever time period, and then you'll get a different price. And then you put another 20% in over the space of 2 to 12 months. You'll drip feed this money in at different points. But what you'll do is you'll get a nice averaging effect on those prices. And you might, that first investment you did when you really didn't want to do it might actually be your best one.
That's right. Exactly right. And you're right. You never know these things until after the fact, whether it's in a year's time, 2 years' time, those sort of things. And one little point you made before, talking about a fractured market, let's be honest, when in history a share market's never fractured, there's always something going on. There's always, I would say, 3 to 5 key things going on at any time. They're always fractured. So market volatility is nothing new. It's a case where we probably get concerned when markets are just killing it because we're wondering, okay, what's around the corner? Is there anything that's coming up? Oh, okay, geopolitical crisis, Russia, Ukraine, there we go.
Yeah, and like you're spot on. And to me, headlines have a lot to do with it as well too. When you look at, that fall back on the 27th of January on the back of Jerome Powell's comments, no clients called us. No one called us. But that was the biggest fall. And it was still higher than that because it didn't make the press.
No,
whereas
that's right.
Now, we're seeing all this commentary which is creating consternation. And, when it comes to investing, behavioral finance is a massive part of a person's decision-making matrix when it comes to do they invest or do they not. It's very hard to take emotion out of it and just act on a pure, disciplined, professional way. That's why people engage us, to take that emotion out and to do it when they probably don't feel like doing it, but we know it's the right time to do it. And that's the hardest thing with investing in these sort of markets is, there's some people who will always say, I'll wait for the turn. And, but the problem is, and there's been a lot of studies on this, and I'll try and dig some information up and put in the show notes as well too, is, when you look at the first 40 days from the bottom, that's when something like 75% of the gains are made in that turn. You can jump in 2 months later, but you've missed 75% of that return. So it's a matter of not trying to pick the bottom. You're trying to space it out, but be there when the turn happens. And I think that's the biggest thing when we talk to clients is, if you have a liquidity event in the next 6, 12, 18 months, then you maybe shouldn't be investing. But if you're looking 5, 10 years down the track, you got to look back in 10 years' time and saying I should have invested in May instead of June. No.
I know. And I mean, anything that's happening right now in 5 or 10 years' time, it's not even going to be a smudge, to be honest. But one thing you alluded to then, missing sort of the periods or the best days when it's in that recovery phase, really heaps of articles came out off the back of COVID-19, probably around September, December that year in 2020, where in industry super funds, retail super funds, so these are mainly just super fund members. They don't have advisors or anything like that.
Pooled super funds.
Yeah, exactly. Pooled super funds. There were remarkable figures that came out where lots of members moved into the cash fund investments, the cash pools, but because none of them were being advised, they thought they were doing the right thing by pulling the pin and moving to cash.
And they stay
there. They do stay there. They've pulled out when they're actually at the bottom, the worst time. They haven't stayed invested. And then 8 months later, that's when they've slowly climbed back in. But they've just missed 35% of the uprun of the recovery. So a lot of those probably accounts right now, they're still down probably 30% when you look at market movements over the last 18 months.
Yep.
So staying invested counts. I think when you look at some data, I know Morningstar always puts out some good data. They sort of do some analysis, I think, on the all odds going back to 1995. When you look at sort of the all odds on the ASX, that index, a good measure of the total sort of Australian share market, I guess you could say, includes a lot of the smaller companies as well. Going back to 1995, the annualized average up until I think it was the end of 2021, in terms of annualized return, was about 6.5%. Now, what would have happened if you missed, I think if you missed 40 of the best days on the share market over that whole period, your annualized return would be close to about 1.8%. So remarkable what happens when you miss those days. And I guess that data point is mainly about staying invested, and also just a case where, dollar cost averaging can pay out, especially in the long run as well. But yes, it's just one of those things. I think we're in the thick of it right now, but I think in the long run, as interest rates pick up over the next 12, 18 months, I think markets have already priced in everything that's going on.
I think also too, it's important to create an exception to what we're talking about here for those who are just invested in the FANG stocks and the tech stocks. That's a whole different thing. So, and this is why it's important to be diversified across multiple sectors. We have met a lot of folks who bought Zoom, Alphabet, Facebook, Apple, Netflix, the whole lot through the pandemic, Tesla, and they think that's a portfolio, and it's not, because they're going to feel the brunt of it, and those companies rely on a very low interest rate environment to make money, so it doesn't suit them. So if you're one of those out there sitting with a full tech stock, then ignore everything I've just said to you, because it's wrong. In actual fact, you're going to feel it the worst. But if you are an investor that is in tech and health and in consumer staples and, the whole lot, energy, infrastructure and stuff like that, then do follow what we were saying before. But if you're in a tech portfolio, you've got another problem.
Yeah, well, I mean, when you look at tech, so all the companies you just mentioned, capturing sort of the NASDAQ 100 tech index, on the 1 year, that's down more than 14%. And those are the companies which had this amazing bull run towards up in the 2021 calendar year. But now, 12 months later, they're all negative over the last 12 months by about 14, 15%. Remarkably, year to date, that index, that's down 33%. So that's a really good indicator of, I suppose the powers of diversification, rather just going and betting on one sort of select, I guess, industry category. And just the fact that, typically those big techs, they don't perform too well through periods of high inflation. They don't, as you know, they don't pay big fat dividends. They retain earnings. They keep investing in their companies. And unfortunately, when earnings and when you go over the long term, 3, 5, 7, 10 years, well, those earnings right now, they are diminished in the future because of inflation. So that's why they had this big correction. That's what we've seen in a lot of those tech companies. All the share prices have dropped in those on big time.
Yeah. So once again, that's another thing. It's, do you double down on your tech stocks? You need to talk to someone. If that's all your portfolio, you might want to look at diversifying elsewhere. And if you're in Apple and Tesla for the long term and Facebook and Zoom, you need to put money elsewhere just to try and balance out that volatility. Otherwise, you got to feel it the most.
Yeah, absolutely. When you're not taking a diversified approach, as I've said before, and you're just sort of throwing money in those meme stocks, which just, again, stocks that get talked about in a lot of those Facebook groups or Reddits. So these are big ones. Yeah, they've done well for short periods, 6, 12 months, but when you move into different market cycles, that's when you really need to be assessing whether it's worth your while anymore.
A proper portfolio should be diversified across geographically and industry. You know, you're
Absolutely.
not all in one country, one sector. You should be in multiple countries and multiple sectors, multiple currencies too. You know, and that just smooths out that volatility, and just means when you're investing for the future, you have to survive this to get the money down the track. And if you're punting, not investing, then yeah, you're going to have a pretty poor experience.
Yeah, that's right. Chasing your tail, to be honest, never outperforming the market or any select index that you're trying to sort of replicate as well. Absolutely.
Exactly, Sam. Mate, I think we'll wrap it up there. I think we've made our point. You know, is now a good time to invest? The answer is yes, as long as it's in a diversified and pragmatic and structured way. But as always, you know, we love the feedback of our listeners. First of all, a couple of housekeeping points, guys. We'd really love to get some more reviews. So we'd sincerely appreciate it from the bottom of both of our hearts if you could write some reviews on us. To us, it's a matter of trying to get this channel as noisy as possible in order to, you know, educate expats. That's all we do this for. We don't get paid for this. You know, we give out a lot of information for free. So all we ask for is that feedback in terms of review. Also, too, we would love, you know, some commentary from you guys in terms of what you want us to talk about. You know, we do cover a lot of topics and a lot of information, but if you're watching this on YouTube, please put in the comments below. If you're listening to this on any of the podcast channels, I'll put a link in terms of what you can click on in order to give us a bit of feedback. And then don't be a stranger. Please let us know, because we're driven by you guys. We want to talk about topics that are important to you. So by all means, please let us know.
Absolutely. Send through some topics and queries. Anything you want us to throw up there. Brett and I, we love to dissect this stuff. So send it through. We can talk about it. And I'm sure you feel great knowing that it's been put on this platform as well. And it's always nice when you hear your topic actually sort of mentioned and talked about. We'll do a bit of a shout out as well.
Yep, definitely. So, mate, let's leave it there. And I'll see you on another episode.
Sounds good, mate. Speak soon.
Thanks, mate. Take care.
Bye.